Friday afternoon, straight after the 4:30 news, so you know what that means. It's time to talk about money with Luke Smith from Envision Financial. And I'll tell you what, it's a very special day today because, ladies and gentlemen, the good news is Luke Smith has emerged from isolation and is in the studio.
There we go.
How about that?
Who would have thought?
How has it been? It seemed a bit strange coming out from all those weeks working at home.
You know, it's funny, I was just saying earlier before, the producer, you know, how long's it been? And I think you've worked up at, is it 7 weeks?
I was at home for 7 weeks.
Yeah.
I've been back here, so a week and a bit now. So, you were away for 8 weeks.
Yeah, look, it literally, you could click a finger and I'm surprised it's that long. It didn't actually feel that long, I think, because we were quite fortunate in that we've been able to operate and provide service and continue to do what we do, which we're, you know, extremely grateful for, relevant to what other people have got going on. So I've found that in light of COVID and what we've been doing work-wise, I think the weeks have just flown by. And you know, I often say every other day's Friday, and it's actually quite weird to be sitting here.
They always say it's better to be busy, and of course you've had no shortage of things to do.
No, look, exactly. We've been flat stick, and you know, we've tried to be available and be contactable. And as I generally say to most people want two things from somebody like me. They want confirmation or information. And as long as they can get it by phone, by FaceTime, by Zoom, by Google Hangout, by this, by that, by whatever else piece of technology you want to use, people are cool with that. And I've got no problem with that. So we've been flat stick. So
I'm kind of guessing now that going forward into the future, you might be doing that a lot more often, because for some people it'll be more convenient than having to tramp across town to go and visit an office, do all that sort of thing. Yeah,
look, I'm really happy this has happened, in the sense that some of the positives that will come off COVID and the things that people have worked through are, one, their acceptance of tech, and a forced acceptance of tech to take away the fear. I found we've always been pro-tech in the office, and a lot of people have run with that. But the proportion of video meetings now, and the efficiency and the accuracy and the simplicity that you can take away the fear from a third party and be able to have that face-to-face interaction. I'm pro, even if we go back and work in the office at a point, I'm still happy to offer that, you know, on a full-time basis, because it's the new norm, and I think we need to run with that.
Today we're talking about how to maximise your tax deductions before the end of June. Yes, well, here we are. It's the, what is it today? The 22nd of May. So it is about that time, isn't it, when we all start to think about, how can I get rid of my money? Correct. Which is basically what you're doing, unless you think about it very, very carefully. I mean, yes, it's one thing to get a tax deduction, but you also got to think, well, do I really need to spend my money? Because you've got to weigh one benefit against the other. Yeah. Before we get into all the nuts and bolts and the nitty gritty, let's start at the very beginning with the COVID-19. The Australian Tax Office announced, they made a ruling a couple of months ago now, I think it was, that for people who had suddenly found themselves working from at home, they would be allowed to make a standard deduction for their working from home hours. So guess how much it is that you can deduct for working from home?
Surprise me.
52 cents per hour. So what's that, $4 a day?
Woo. And breathe easy. We can
generous, aren't they?
We can go to the pub now. We don't need to talk about deductions. No one that's out there.
So if you're not happy with $4 a day, and you'd like to do a little bit better, what should we think about?
Well, I guess this sort of is a culmination of multiple shows, you know, because we've talked in the past about personal deductible contribution, and that is the flip. For those out there that don't know what that is, that's where you take your own money, you put it into superannuation, and you claim 100% of that as a tax deduction. It's the opposite of the old school way of doing it, which was salary sacrifice, where your employer took the money out during the year.
Right.
A much sharper way of doing that now is obviously to pay off your mortgage, use an offset account, and throw the money into super up to the $25,000 limit. So that's one way. So make sure you're maximising your contributions, because if I give people a choice and say, do you want to pay tax of $3,900 on 10 grand or $1,500 on 10 grand? We know which one they pick. So that's a $2,400 saving on a $10,000 contribution to super, where you're earning between sort of 90 and 180, which is an average bracket for people working in the government, I'd say. So that's something to think about leading into June. The other step off from that is the carried forward legislation, which allowed you to use any of your unused concessional cap from last year. You can bring it forward and put it in this year. So let's talk about that one. So we know 25,000 is the max, and let's say 10,000 went in from my employer. Okay, I've got $15,000 from last year that I didn't use that I can bring into this year. So I've got 25 to use, plus the 15 I didn't use last year. That gets me to 40 in total for this financial year. So think about the carried forward legislation. Now, two things to keep in mind there. Balance of super must be under $500,000. And you can only roll forwards for a maximum of 5 years.
Okay.
So that's a really, really good one for those that didn't use it last year or didn't have a job, change your contracting arrangement, you've saved up some money in your offset, you've inherited some cash, or you've started a pension this year, and we'll get to this one. You've started a pension from your super this year, and you're going to pull the money out and put it straight back into super and claim a tax deduction. We'll touch on that one in a little bit.
That sounds a little bit sneaky.
Those two are very important. Obviously, think about prepaying the interest on loans. Okay, if you've got a margin loan, gearing loan, or any sort of loan where you can go to the provider and say, hey, what's my interest in the next 12 months? Can I pay it this year and claim that deduction in July and bring forward what you're going to put in your tax return? That's a very good way of doing things. Income protection. For those out there that are smart enough to have income protection, obviously the premium is generally tax deductible where it's in your own name. You could make an annual payment of your income protection premium now, or you could start a new policy now, only have it in force for 2 months of this financial year, but claim the 12 months of premium in this financial year as well. So that's another one where you know that things are going to be deductible. For the self-employeds out there, obviously they've got the $150,000 write-off. So that means you can go and buy equipment and various other things that are associated with your business. And rather than depreciating it over a number of years, up to $150,000 before 30 June this year, you can claim all of that in this financial year, which is obviously there to try and get people out to buy things, stimulate the economy, spend some money, get things moving. And
does that include buying a new company car?
Yes, it does, but there's a couple of caveats there. Obviously, you can only claim up to the luxury goods tax of about $57,000. But again, if you're going to look to try and get equipment, cars, diggers, vehicles, plant, anything that's significant, it's a very good way of getting an income deduction in totality this year.
Up to $150,000, but if you're buying an asset of some kind and you don't actually have the cash, can you borrow the amount of money you're spending but still claim the deduction for the amount that you spend, or is that cheating?
That's where you ring your accountant. Full disclosure, not an accountant. Ring Reese Keebers from RSA and he'll be able to answer for you. Andrew's Nigro at Hardwoods, he's all over this stuff. Not my wheelhouse. But there is a catch there. Obviously, you need to have it. Okay, if it's plant and equipment, you've got to be using it. It's got to be installed and functional. That's what I was told today by the boys. You can't buy something and not have it there. Okay, so you can't pay for it now and get it in 6 months.
Can't place an order.
The other one is the instant asset write-off for more than $150,000. That one actually then says, okay, you've got till the end of 2021 and you get 50% you can write off. So if you've bought $1 million piece of machinery, you can claim $500,000 of income deductions in this financial year, but it's got to be installed and functional.
And then amortise the rest over time.
And that's where you ring your accountant again.
Yes.
Correct. Yeah. Don't ask me about the back end of it, but the front end looks amazing.
All right.
Don't worry about the functionality. That's why accountants do what they do. That's their wheelhouse.
Absolutely.
We'll leave them to their knitting.
Oh yeah, well that's right. I mean, if you're doing your own taxes, you're probably costing yourself some dollars, aren't you?
Oh, 100%. Like, if you don't have an accountant helping you, you're crazy.
Yeah.
And the last one in there, obviously, that people should be thinking about now is, do I need a pension out of my super fund? We laughed a little bit earlier, but if take this scenario, I'm 60, I'm working, I haven't saved enough money during the year to put some money into super because some things have popped up, or I've had to throw the kids some money, or I've had to buy a caravan, or do whatever you want to do as you prepare for retirement. What if you took an annual pension payment now or prior to June, pulled the money out tax-free, then put the money back in before June and claimed all of that as a tax deduction up to the $25,000 limit? Now, that's very good for your contractors where they may not get superannuation support, or if you've been working part-way through the year, and let's say you already receive a CSS or PSS pension.
All right.
Let's say you receive a government pension and you went back in January and did a bit of work and did some contracting, and your taxable income has risen significantly. You could probably do with a tax deduction, but you may not have the cash line around. So you could make a pension payment now, get the money out. If you're over 60, it's tax-free. Put the money back into super and claim it as a tax deduction. And all you've done is take money out of cash, put it back into cash, and you've reduced your taxable income by whatever you put in.
That sounds like black magic.
Well, it's just about, sharpening the pencil and, as Packer said, don't pay any more than you need to.
Well, that's exactly right. All right, so how do people prepare to make the most of these options?
All right, so if we think about the first two, which we talked about, which were personal contributions and the carried forward legislation. So obviously checking and seeing what your space was last year. So those are out there in the government. If you're with ComSuper, you can go on the website and you can check your concession or cap space, and that'll give you an idea of what's been assessed against your $25,000 limit. For the self-employed people out there, if you put contributions in, just check with your fund, ring your payroll officer, bring your accountant, but get that money in through the use of either pension payments or pulling money out of a redraw or offset account, okay? Because if we come back to that pension strategy, if you made an annual pension payment now, you can make another annual pension payment on the 1st of July, right?
Of course.
So you've got 2 years pension payments to fund money that you've taken out of your offset account to throw into super to pay your house loan back off. You can really make it complicated, but given the cost of money.
Sounds like shuffling the cards in the deck.
Well, it's all about bending and not snapping, right?
Okay.
So time your pension payment to fund liquidity of contribution. Use an offset account to make sure you've got access to money at short notice, because you may not be able to salary sacrifice enough money between now and June. Purchase things that obviously bring forward that deduction, but you're going to have to get cracking on your purchase because you have to have it delivered, installed, and it be functional before the end of the year. So have a think about that. That also applies to second-hand goods. It's not just a new purchase.
Oh, okay.
Right? So
it doesn't have to be brand new.
No, you could buy a second-hand car and still benefit from those income deductions.
All right, so the Ferrari can be second-hand.
For sure, yeah, why not? Yeah. You find the one I'll fit in, I'll have a run. That's exactly right. Obviously, you've got the luxury goods tax, which is, I think, washes up around 57,000, which is the most you could claim in that instance on a luxury vehicle. So be mindful.
Does the luxury tax actually apply to second-hand cars? That's only on new sales.
No, I think it applies to everything.
Does it? Okay.
Yeah.
I wouldn't know.
Again,
I can't afford them. I work in radio, remember?
Refer to your accountant for confirmation prior to purchase. But that's important because a lot of people think it just has to be new. You can actually buy second-hand stuff. And make sure, obviously, again, from an offset perspective, offset accounts are really, really powerful now, because if you've been a really diligent saver during the year, you should have a ton of cash sitting in your offset account that you can use to prepay the interest on investment loans, prepay your income protection, or make contributions to superannuation, which are all very beneficial because it'll let you maximise your deduction. And with money being so cheap, you're not going to incur a lot in the way of interest when you compare it to the size of the tax saver.
Yeah, that's right.
Because money's obviously the cheapest it's ever been. So, there's some ways that people can actually use the resources that they have to do what they want to do. But again, don't leave it to the last minute, because we need to keep in mind here that funds must be cleared and in the account for them to be deductible for super. So if you make a payment on the 28th of June and it lands on the 1st of July from a processing standpoint, ba-boom.
Too late.
It's tears.
Yeah.
It's got to be in and cleared.
This is the sound you wanted.
Oh, there we go. And you know what? There's plenty of those. And another one, a little sneaky one that gets missed a lot, is check your super fund balance, because the last 2 years, the end of financial years occurred on a Friday. The last working day, and then the end of the 30th of June has been on a weekend. And some payroll people have made the payment prior to that Friday, but the money hasn't landed in the account until the 1st of July or later.
Of course.
So just check that you don't blow over your $25,000 limit because you think your workplace has paid it on time, but it hasn't landed in time for it to count in your fund, which would blow this year up.
All right. Now I'm just looking at this year's calendar. So this year, the 30th of June is a Tuesday.
Right.
So that helps.
Yeah, so you want money in then, what's that, the 27th is the Friday? 28th?
26th is the
26th
Friday.
is the Friday. So you're going to have money in and cleared by the 26th, just to avoid the fear.
Yeah.
That's right. Because, in this day and age, if everything else is COVID affected, it could take 3 months to process a rollover.
Now, we're going to run out of time here. I was just going to ask about this little item on the notes today. If the government passes a change to allow the long lunch to be deductible, that's wishful thinking, isn't it?
Do you know what? I reckon it's a great idea.
Of course it is.
I think
it's a fantastic idea.
I've got some buddies of mine it'll be late week.
But are they going to do it? No, they're not.
They're not?
I don't know.
Well, they should.
I bet they don't.
Well, if they're listening, throw everybody a bone and do us all a favour.
If they do, you can take us all out to lunch. It's 10 to 5 on 2CC Canberra Live until 6 o'clock. Back with more after the break. Until 6 o'clock. It's about 7 minutes to 6 now, and in this half hour I'm joined by Luke Smith from Envision Financial. We're talking about getting some tax deductions ahead of June 30, which is just around the corner. We have to move quickly, don't we, Luke?
Look, I think again this one is all about managing expectation. If you leave it too late, it's going to hurt. So I think that's why it was probably topical now to talk about it, because it gives you a couple of weeks to sort of line your ducks up. Obviously, if you're going to think about finding the money, offset account, good source. Redraw facility out of home, good source. If you're drawing money out of an investment property, be careful if you're using a redraw facility, because you may be changing the purpose of the loan, which could impact the tax deductibility of your borrowing. So check with your accountant in relation to that. Think about using a pension payment to provide some liquidity to fund some of these things. If it's a prepayment of interest, prepayment of income protection, or you want to then make a contribution and claim a tax deduction, a pension over the age of 60 that comes out tax-free is a good way to do it. And just remember, you could always use your offset account and a pension payment, and then use a pension payment in July to pay back your offset account. So you need to think past 30 June in relation to where you can get the money from, because that can have a lot of value if you're using the carried forward concessional rules from last year, because most people don't have large amounts of cash just sitting in a bank account being idle at the moment, given the rate of return.
No, it tends to evaporate, doesn't it?
It does, and I'm a big advocate of out of sight, out of mind, or it'll go on something stupid. Buy a new car, claim the deduction. If you're going to buy it pretty soon. Everybody needs a new car. Everybody likes a new car.
Well, the thing is, not everybody can actually claim it as a tax deduction, can they? Can they? If a person is a private individual, you're just buying a car for the hell of it.
Check with your accountant.
Yeah, exactly. It's got to be for business purposes, hasn't it?
Well, I think it needs to be run past your accountant.
Yes.
Obviously, for the self-employed, the equipment and the finance and whatnot, they're huge deductions. They're really, really good, because obviously, if you can bring forward multiple years of depreciation into one income deduction, that'll be very, very advantageous. Prepay your gearing loans, claim your tax deductions, prepay your insurance. And if you don't have it and you think about opening up or taking out a new policy now, think about an annual premium payment at the moment, because you'll be able to claim a whole year's worth of premium in July, and you would have only had it in force for 2 months. Yeah. So there's some ways that you can do it, and some ways to get the cash you need. You can obviously pull some money out from under the mattress. That also works. It just depends what your preference is.
And how much is under the mattress.
Correct.
Right, so if we want more information, Luke, where do we go?
Yeah, so obviously we've got the YouTube channel, Envision Financial Canberra, where we've got the interviews we did recently. For the self-employeds out there, bankruptcy is very topical at the moment, insolvency and the impact of COVID. So we did a really good interview with Jonathan Colbrand from RSM. That's up there. Obviously, he's a specialist in that area and sort of demystifies the bankruptcy term and insolvency and some of those scary topics that get thrown around. Obviously, give us a ring in the office, 6260-4749. We've been working full time as we've discussed, so we've always got time in the diary for a Zoom meeting. The podcast, the Strategy Stack of Luke Talks Money on iTunes and Spotify, that's on there now as well. And envisionfinancial.com.au, where you can go to the Knowledge Centre and join and subscribe, and there's a whole library of information there if you want to check it out. So.
Fantastic. Thanks very much, and we'll catch up with you again at the same
See you
time
next week.
Next Friday. That's right.
Same
Every Friday. Thank you. Every Friday afternoon, straight after the 4:30 news. Right now, it's about 3.5 minutes to 5.
Canberra.